Okay, awesome. I could
What's
even
up, everybody? Erik here. Welcome back to All the Outliers. We're kicking off another Outlier podcast. I got my friend Patrick here. We were literally just talking about TA. So, one, welcome back. But two, let's get right back to that conversation. You were talking me through the context of using technical analysis and relative timeframes, and I thought it was too good not to record it.
And well, I'm happy to be here. It's always been like that. Like always the conversations I have with the interviewer before, it's like, man, even me when we host people, I say, okay, I should have a habit of hitting record, and then just because there's stuff that's gold. And yeah, I look time frames. I posted something on Twitter. I could maybe share my
Yeah, go for it.
my screen there
Yeah,
just to show people. Wait,
you should have
share.
rights.
Yeah, there you go.
Bingo.
So I did this a while back because, okay, chart basics on charts, guys, chart trading, and I always trying to, I don't want to use the word educate, but just share this information. In chart trading, everything is defined by time frame. And often you'll say somebody, oh, I have a breakout's confirmed. But people who don't know about chart trading, they just hear the word breakout and they think it's a buy. And then they take their mindset, their time scale, and they apply it to that word. But you have to know, where did that breakout, where was it defined, in what realm? Because if the guy says it's a daily chart defined breakout, and you think, okay, I have a breakout, I'm going to ride this for 8 years. No, there's going to be many breakouts and breakdowns on the daily chart. While if you have a long-term scope, you should probably be looking at quarterly charts. And because if you have a chart defined breakout on a quarterly chart, that thing's probably, before it breaks down, you're going to get 5, 6 years, whatever you're able to run. But within that, there'll be run-ups, then you'll have breakdowns on the smaller time frames, and then we could use like shorter term moving averages to be able to exit into that, like, shorter term FOMO. So depending on the chart type, candle charts, line charts, point and figure charts, they each have their own parameters because and they each have their own time frame, and all that has to be pondered and weighed accordingly. So that's why I love December. December, it's crazy, Erik. We're coming up. December, guess what, guys? December 29th, it's a yearly candle close. It's a semestrial candle close. It's a quarterly candle close. It's a weekly candle close and a daily candle close. Man, I'm going to be working during the holidays. If ever you get it, you do it only once a year, guys. Look at those yearly charts, those semestrial charts and quarterly charts like now, because you might have the greatest entries right now after Christmas when you get those yearly candle closes. And if you get a synergy of all those breaking out at the same time, it's like golden. It's like people are looking at the gold chart. Gold had a weekly defined breakout, had a monthly defined breakout, did not have a daily yet. It could possibly get a quarterly breakout and yearly and semestrial in a week or two. So if you're patient, before just like jumping in all in, just give yourself a week or two, let the dust settle. Let's see how the year closes. And that could remove a lot of noise. Because I've seen so many times people jump in. Let's say even somebody says, oh, look, Patrick, I'm on the monthly chart. The price is way above. Let's say I have a breakout line at 1,000. And during the month, the price 1,200. It's convincing. And I've seen it so many times. Even me, I fell for it. Oh, man, it's not going to go back down below the breakdown line. There's only 2, 3 trading days. And guess what happened? Bam. The price goes below the breakout line. It leaves a wick, which I call noise. That's why Japanese candles, they're like awesome, because it's the close that matters, the body, and the wicks was noise from the smaller time frames. And how many times I've seen these possible breakouts, but because I did not wait for the monthly close, I got trapped. Look, you have the best example here. I'll show you the let's go down memory lane. I'll show you the gold chart. Here is the monthly candle chart. And guys, it's always important if ever you go on the chart, always look at the right here at the time frame. All these wicks here, somebody could have thought it was a breakout. Oh, look, during the month, for 1 month here, it was out of the cloud. 2 months, 3 months, 4 months, it was above this breakout line. But every time it trapped people. What you want to do is you want to wait for a drastically convincing breakout. Like this removed all doubt. It even cleared the wicks, which is optional, but it solidly closed above all these closes. And that's how you reduce noise. And this is how you have a higher probability of having a sustained run is once the market's clear. And look, this is another thing. People often tell me, well, Patrick, you missed a 70% move. Well, guys, this is a revelation I had recently is a good chart trader will learn to know which moves he needs to avoid, which moves to not enter, right? Like you should never have FOMO as you see this going up, but you have a clear breakout line above. This move, yes, it's adrenaline rush and it's bonkers, and you say, oh, I'm going to get in early because I'll be able to buy more and then I'll make more money, right? The greed factor starts kicking in, but you got to say, look, it's going up, but you want to be trapped unless your play was to buy like the move up and sell at the resistance. But if your idea is to buy anywhere in this basing formation because you wanted to play the fast reverse symmetry move upwards, then the probabilities, as long as you're below this line, the probabilities will always be lower for you to have a crazy move like that than after you're above. Because once you're above, then this resistance now becomes support. And so like 80% of the time you have a pullback. But this one was so convincing. We practically didn't have a pullback, but most of the time you have some type of pullback to retest it and then it shoots up. So never fear of missing out. The lion's share, I tell people, it's this move here. This is a lion's share of the trade, and you can't even catch probably the top. Somebody could have probably even sold even at previous highs, even here at the wall. The move you could have just traded this move here, huge base, and in 2-3 months, bam, you're like, it's done, right? The move's done. But these are the lower risk plays. So this is like where we are today for gold. A lot of people like, oh, gold can't go down. Well, look, I don't know what if your thesis is wrong? That's what I tell people. People in hindsight, they say, oh, look, I told you, Patrick, I bought here. I'm a genius. Well, okay, well, what if the price would have went down? Like, how do you conciliate all that? Always wait for the breakout. And even after you get a breakout, it could still fail. So it's not 100%, right? It's not 100% probability, but statistically, once you've cleared convincing resistance and breakout line, it's supposed to go like that, right? 80% of the time. But if it doesn't, then no problem. It fails, false breakout, you exit and you wait for a new pattern to morph into existence, right? And each time you get a failed breakout, a new pattern morphs into existence, and then you just wait. You don't want to get trapped. Anybody who bought here, unfortunately, they got trapped. See all these wicks? That was crazy, Erik. Look at these wicks, traps. Even me, I was like, the emotions, they get you, right? Oh, look, the price is above, but look, by the end of the month, the price sunk back, all these wicks. But look, I know gold did a crazy spike overnight there, but it doesn't get more convincing than that there. Like, unless you get something like you had back here in June of 2019, that monthly candle close was very, very convincing. And even here, intra-month, this month, the price action was all the way down here during the month. It was red candle. It looked terrible. But then after that, the buyers, they came in, and what we have right now is some type of a spinning doji. It could be here, like here in January of 2020, February of 2020. We'll have to see if that's going to be a continuation or a top, but you're above resistance, the trend, you're above the 1-year moving average, above the Ichimoku cloud, above the 3-year moving average. The bias is on the monthly time frame. The bias is it's upwards, right? I know I've been hearing people like giving some $1,200 target for gold and all that, which is fine, but you have to weigh that. What are the probabilities of having 1,200 gold at this stage today? So I would tell people, as long as you're above an inclining 1-year moving average and you're above a rising trend line, above the 3-year moving average, then the probabilities are reaching 1,200 right now. They're just not there yet, right? It's just like here when the price was going down for gold, and somebody tell you, well, gold has to skyrocket back up to 2,000. Well, the probabilities of gold skyrocketing to 2,000 as it's trending below a 3-year, trending below 1 year, the lower. they're just slower, and then you just need time to heal. And yeah, I'm sorry, I just went off on a tangent there, but all these things they all link up together. I could have done this on the, let's say we have the quarterly close for gold. So this is what we're dealing with for the quarterly close. Even here, this is very aggressive. It's a rising, look, a rising trend line when it breaks to the upside. Often either it's a false breakout and the price reverts down, or you create some type of sometimes some people call it a Livermore accumulation there, and it just squeezes up and then it just goes bonkers. We have to wait now for the end of the month. There's that wick. If gold is able to close 2060, 2070, like anywhere, the higher it is, the better it is, then that's another milestone in favor of gold, just like, pushing upwards. What about the yearly? I could even do a yearly chart for gold. Yeah, look at that. So on the yearly chart, that's a pull flag, right? Pull, flag, and that would be a continuation breakout, right? Then you could start doing measured moves. I don't know where, maybe it starts here. You'd add that here, and then that would be your measured move. Yeah, 2,700. It looks great on the yearly. So people have to match their time frames. And you'll see here, this is another thing. The higher the time frame, it's kind of fun though. I hope a lot of people get to watch this. The higher the time frame, the lower the threshold for a breakout. Because the time frame is higher, there's more time for the wicks to form. The more noise the higher time frame candle. So this is 12 months. It's the whole year. Look at the breakout line here. It's 1897, the breakout line for this continuation. It's much lower than on the, where was I on the monthly? On the monthly, we had, see, here's the yearly one. The monthly, it was 1990. And even the daily, it's probably even higher because the daily chart there's a lot of closes on the daily chart, which is actually the wicks. Well, it will be the wicks. Most of a lot of the closes will be wicks from the higher time frames. So let's on the daily chart. It's like there's no confirmed. I'll put here on the line chart just to remove the noise. Look how much higher the price point you need on a daily close to break out. So the higher the time frame. So often, I don't know, like, sometimes I have some teachers, Erik, at school there, they let, when they explain something, they put the pros and cons of each thing. So yes, oh, that's a big tank. It's strong, it's powerful, but on the downside, it's slow, it can't maneuver. So the time frames is like that. The hard time frames, like the big tank, they're powerful. Once they get going, you want to buy the dips once you have a higher time frame confirmed breakout. But the shorter time frame, there's not even a confirmed breakout on the daily chart practically. It's you'd have to maybe draw a slanted one, make a case, but it's noisy. You see, even here, you could have had a false breakout on the daily chart. It failed. But now because the monthly and the weekly broke out, it's offering that longer term support to help the daily chart, push upwards. And you're letting me rant too much, Erik.
I like listening. That's why I like doing these. Is I have an opportunity to learn with everybody else. One of the questions I had though is early on, you were talking about the relevancy of a close versus a wick. Can you talk more
Yes.
about that?
Yes, definitely. So let's go back to the candles. Here, I could even do, I'll do one better, remove drawings. I'll put a vertical line at the 3 months. Okay, when did the year begin? The year began January 1st. Let's do last year, September, October. So September was the quarter started September, and here we are today, right? I'm on the daily chart, so this is probably going to be here when this is September, October, November. No, October it starts, right? October 1st. Okay. There's a whole bunch of closes here on the daily chart, right? And here you could say I have a breakout right here. There's a breakout here. Then after that, it tests some longer term price action. Here, maybe if that's probably even a false breakout here on the daily chart. If I stretch that, possibly a false breakout on the daily chart. Now, the month started here. The price went all the way up here, kept going up. So the quarterly candle chart will start green at the bottom, go up. But because right now we're below the beginning of the month, or we're not at the high, we're below the high of the month, this will be a wick. All that noise here is going to be a wick. And the higher the price goes before we close the end of the month, that noise intra-month will disappear, and hopefully you get a Marubozu candle where it's the close, the entry and the close. There's practically no wicks. It's just power, no sellers coming in. I'll just put on the quarterly, reset chart, zoom in, and you'll see, look at that. So here's a quarterly close. It's beautiful. Here was October 1st. Well, yeah, it's going to be here when we're done. And now we have just that wick here. I have to remove these lines. That's the wick from the smaller time frames, which doesn't need to disappear, but that's that spike we had intra-month going there. But right now, that's noise. And if ever the price goes back all the way back down to 1971, then you don't even get that breakout there. It's totally that poorly defined breakout is not there anymore, and it trapped anybody who thought this will close above that breakout line here for the quarterly chart. Did I help? I might have confused things a little bit. It's
I don't think so. I think the way you framed it is pretty clear in that you view the wicks as shorter term noise, and the close is the more dominant feature for you.
It's yes. And look, another way to do it, guys, if you don't want, just put a line chart. Just put a line chart. And that's it. There's no noise here. You get, these are closes, but yeah, you have to understand that there will be noise from the smaller time frames. And yeah, you could do it at old school, just a line chart, and that's fine. I just like knowing what's the beauty of being on the monthly chart and having candles is you're able, as a chart trader, once like you're used to it, you see the closes, right? I could practically visualize the line chart there, but I like knowing the wicks because the wicks give you details from the intra-month, right? Was it an exhaustion wick? Did some crazy action happen during the month? Because that's another thing I put on Twitter is I would always rather a month that starts weak but closes strong. It leaves a wick here, like some type of capitulation wick, It went super weak. There's a wick. The price goes up. It closed strong. I would always rather that than a month that starts strong and then closes weak and then leaves like here, like a huge, like the whoever's like the hedge funds, like I don't know, they especially the quarterly chart, they readjust, rebalance ETFs. They're not day traders. Like huge money, those capital flows, they readjust at the end of the month, end of the quarter, stuff like that, and they could just like bring the price down back below. I don't that. Of course, I would always, the best case is a month that starts strong and ends strong, right? Everybody wants that. But so that's why I don't feel too much FOMO, like intramonths. Oh, the daily chart, gold's going crazy, or any instrument there. Now we're just picking on gold, but goes bonkers. It kind of scares me sometimes because I say, okay, if the sellers come in, they could create some type of ugly candle. Because like back in March of 2022, what do you think the feelings was for everybody here? Like I could even do a trick here for you. I'll put the fast forward button. I put play. See, it's too fast. I'll slow it down. Anyways, let me just back it up. It's replaying the month. See, during the month, I just put on pause. During intra-month, that candle looked like that. How many people, gold's the best, the rest is the worst, all the gold bugs jumping up and down there. Like everybody must have been crazy here. But if you continue playing it out, oh, the sellers came in at and the buyers weren't able to bring it up. Then we get a new candle and all hopes and dreams got shattered there, like the boulevard of broken dreams there. It's terrible.
What do you think about picking the correct time frame to analyze something? How do you do that?
The holy grail of time frames. Well, the first thing people have to match is the time frame. They have to match the time frame with their emotional. Yeah, a good trader has to understand his emotional state of mind. Does the guy want to be super active? Because if he's on the monthly candle chart, he's not, he's gonna lose patience, right? You have to match the time frame with your emotional profile, your emotional capital. Like, are you gonna want to check once per month for breakouts? Then if that's all you want to do, then you have to go to the monthly candle because you'll get all the advantages of the monthly candle with and the drawdowns of over trading. You don't care. You just want to trade once per month to readjust your assets. But if you're somebody that wants to check every day, then maybe a daily chart could be good for you. But the advantage of a guy who does it for the daily, if he happens to coincide his buying at the beginning of a month, then it's win-win for him because he gets to leverage the higher time frame and he's still in his universe of the daily chart. Look, I'll tell you what the pros and cons. The longer the time frame, the lower the threshold to get in, but you have to wait way more before you get to enter, but it will create more powerful moves. The dips will be bought more often than sold on the higher time frame you are, and the shorter time frame, well, you get to participate more, but you will get whipsawed so much more. So it's crazy on the daily chart there. But
It's funny you bring that up because when I look at my world, which is primarily derivatives, it's the same thing. Like traders like trading shorter term time frames, but that's exactly what happens there as well, is they just get pieced up and then they wonder what happened. So it's just funny to me to see completely disparate styles of trading, but some of the same underlying tones, one being extend your duration and you might find things to work a little bit better for yourself.
yes, and it gives you time to breathe. It gives you, there's like, imagine if I told Michael Jordan and he's in the playoffs and the defenseman will give him 5, 10 seconds extra for him to take a shot. He'd be okay. It's perfect, you know? But we're not all Michael Jordans. We don't have his emotional capacity. We can't be rushed all the time with Twitter info, with fun. And if people do fundamentals on top and they're analyzing this and move so fast, goodness, man, it's going to give me a heart attack, you know? So and you might make mistakes. You might make operational mistakes, just punching in the order. Oh, the sell stop, you made a mistake. And then something gets triggered. Um, the markets are volatile. You could get crazy sell-offs like you had in FedEx, could go down 10% one day, up 8% the other day. And then if you don't account for if you don't use like ATR or some type of thing to help you like measure the volatility, man, the market loves just grabbing you, grabbing those sell stops. I don't want to go in conspiracy theory, but the market's volatile enough to, like, if you're too close to the action, you're gonna you'll get triggered out before your profit limits will get hit, like practically a lot of the times, right? It's yeah, I did it. I used to do like a lot of forex. I was on the shorter time frames playing the news releases, economic news releases. It was uh, you have to adjust your style, the time frame to your style, and so that's probably number one. Look in the mirror, guys. Understand what type of personality you have, how much time you have to allocate to this. And then I think your trading will get a lot better once you match the time frame to your emotional state of mind.
Makes a lot of sense. I think that applies to trading writ large. So again, that's another very common theme I find even with derivatives trading. Again, people have to figure out if they are looking for lower win rates but bigger wins. That necessitates a certain kind of strategy. The inverse necessitates a different kind of strategy. So just another parallel. It's funny because when you talk to traders, there are commonalities amongst all of us, slightly differences between what we might look at, what we might use, but threads like that I find to repeat themselves. You talk a lot about trading bullish directions. Do you view bearish trades as well? Do you put those on or not so much?
Well, not so much. Look, let's say somebody wants to short the SPX, but if you look over long periods of time, let's pop up the SPX there. The SPX has everything going for it, even the NASDAQ. Let's think like it's an index, the 500 top companies. It gets to rotate out the least performing companies. So it's already that. It's got 11 sectors. So the least performing sectors could pick up the slack. So when the top ones like don't really do that good, you know. So the drawdowns, there will be drawdowns, but it's like if I have a 200-year chart. Here's the SPX 1871, guys. It's if you zoom out, it had periods of time where it went sideways for 10, 15 years, 10 years here, 10 years here, but overall, statistically, it's more up than down over long periods of time, right? So on that basis, it's tough. You got to be really nimble. You really got to understand the evidence. So let's say I want to short the SPX, like let's say the GFC. Well, here it was a higher probability short because it was SPX had already broken down versus inflation or versus PPI versus CPI versus gold. So it was more this at this stage here, it was more probable of failing this rally and getting a rug pull. So here you could have probably shorted, but it could have been shallow like here, you know, here even SPX broke down versus PPI back here, but they're tricky to short. So I rather on currency pairs, I wouldn't mind where it's a zero sum game, like that like direction there. But when I see a chart like that, the SPX, I would rather wait until it's bullish and buy the dips, or instead of shorting the SPX, see what it's underperforming and go the other asset that's going long, that's outperforming it. So here is gold, SPX here breaking down versus gold in 2002. Instead of shorting the SPX, and because of all the reasons I mentioned there, it's like all the money's flowing to that always. It's like it's a great adrenaline rush, right? Everybody like goes bonkers. Oh, the Dow is down 800 points day after day. Like it's crazy feeling, right? Especially if you have a little bit of contrarian in you and you like you want the system to break. You kind of but it's statistically probably it doesn't happen as much as people think it should happen. So if the SPX is breaking down versus another asset class, I would probably look to go long the other asset class, which is outperforming it. Because I'll show you something here. Here is gold versus SPX, and I'll just overlay the SPX on top of it, and I'll overlay also gold. And you'll see here that, oh goodness, the scales got messed up. You'll see here that while the ratio of SPX versus gold is just plummeting, look at this here from the 2003 bottom. Here's gold, 2003. SPX and gold go up together, but the ratio goes down. One's outperforming the other. And that is good because liquidity is going in the SPX. Gold's sensing or pricing in whatever the monetary imbalances, the destruction of the fiat required to save the SPX. And then you get a double whammy. Now gold appreciates in price and gets the support that the SPX is getting on the way back up until one day the SPX breaks out versus gold, like in back here 2013, gold breaks down and then just go long SPX. So yeah, I would short stuff. I would short more, let's say like anything that goes against like against the stock market. That would probably short that. While the stock market's going hot, then the sectors that are doing so good, probably like let's say energy, gold and silver miners, like they're just terrible like 90% of the time. It's kind of weird, Eric. I don't know if you know this, but people are attracted to what is statistically least probable because they have some clickbait type of gain attached to it. It's like people want to play the miners all the time, but statistically, if you don't have TA to time your entry in the miners, you have a higher likelihood of just dollar cost averaging in losers for long periods of time than actually piling on into something that's actually going up, right? It's yeah, it's like uh, the mindset of regular people is not what a trader's mindset should be, right? A trader's, it's like either we learn because we've brought our narratives and biases to the chart, and then it has to go up because they need solar panels, so silver has to go up, but you're not even looking at the price. Then after losing so much money, I guess people learn, either they learn to accept that the market is always right and we're always wrong. Because I definitely know that I don't know anything. Seriously, it's like whenever I think I know something, the market humbles me. Says, Patrick, what are you doing? That's why I've learned to go back in my shell and look at the chart because the price is never wrong. Never. It's like I tell people that it's like you could have a story, a fundamental story, the P&Es, whatever, it like looks great, but the price, you'll never make money if the price is not going in your favor. Never, no matter what story you have, you know? And that's another thing that's dangerous is you have a story, a narrative, the price goes up and you're aligned with your narrative, then you believe your narrative is driving the price. And when the price starts faltering, you don't believe that the market, you don't understand. And then you think the price is going to go back up. It never does because the narrative never changed, right? Because you'll hear echo chambers all the time about narratives, right? Tesla's, the EV craze, you know, it's always, it piles on, right? And you seek those news also. You'll follow people who will reinforce your bias, right? Even as the price is crumbling 10%, 20%, 50%, and you'll keep following these guys even more. It's tricky. I forgot. I think I went totally on a tangent there, but it's yeah, shorting, you could do it, but a zero-sum game, much easier, the probabilities. But shorting US stocks, you got to be like a surgeon, precise, and make sure you have the weight of evidence that they're really, really in a bear market there.
Yeah, it makes sense, especially for the time frames that you're looking at. I kind of
Yeah.
generally expected that answer from your side. You mentioned earlier some different candlestick patterns. I spent quite a bit of time, probably 10 years ago, doing a lot of analysis and just regression on the accuracy and the efficacy of candlestick patterns. What are your findings on the highest efficacy candlestick patterns?
Well, let me just remove that. The most efficient, it's practically, you have to think it like in the physics. The slanted lines, the more a line is slanted, and I'm going to put my angle thick line here. So here you see the angle. The more the angle, no matter what pattern you have, whether it's a bearish rising wedge or like, you know, but okay, this is not related to specifically to candles. Did you mean like dojis, reversals, engulfing candles, and all the? Did you mean specifically the Japanese candlestick patterns, or just?
What I originally meant was the candlesticks themselves, but I actually like this direction more anyways because I'm more of a formation slash shape kind of trader. So this is a perfectly fine direction.
Okay. Yeah, I don't. I understand the Japanese candles, the patterns, the dojis, the spinning tops, but I don't trade solely by those. I'm a classical TA guy first and foremost. The angle, while a bearish descending wedge, maybe I didn't drop, the target is essentially this. What I've seen, and with the like, we have a trade tracker with performance dashboards. This is what I call a one-star breakout. These are low probability trades. These, while the target's here, they don't often go there the first time, and that's often the bear market rally here that traps everybody. Everybody thinks, oh man, it's breaking out, but you're breaking out of what? You're breaking out of a steep descending trend line. So the momentum is, it's like you're jumping downhill. If you jump, if ever you want to get your foot again before jumping again, you might even go lower. So sometimes, often you hear you have like you have a goodness. See the retest. Well, it wasn't that. It went low here, much lower than it went back all the way down here. Maybe that's not a good example. But this, I have to go on log chart. That's why that looks funny. The steeper the angle, the least probable the price goes in the V shape up. After that, here you would have had a less steep angle, 6 degrees. So this is what I call an early breakout line. A lot of the hard work, the basing, is done by here. You went up, now it created a swing, a pivot swing high here. And after that, it did it again, foiling tight. So the early breakout line is fine, but the best one is a horizontal plane. A horizontal plane has no more bearish momentum, right? Because you have to see those trend lines, or the steeper they are, the more bearish momentum. There's still a lot of selling pressure. The base, the horizontal breakout line it's a flat plane. There's zero momentum, but it's even more bullish because it has zero momentum. And if ever you get a breakout, you know that so zero momentum, but you're adding bullish momentum, because to break out of it, that means you're starting from below it and going above. And that's creating the initial thrust of upwards momentum, but that upwards momentum is not fighting a declining plane. It's fighting a flat plane. So it has almost no more, I don't know when you want to call it, type of gravity or kinetic energy dragging it down as much as it did back here, right? So these are very high probability. Like this is they're so much high probability. These huge basing patterns with flat planes. That's what I play, and we've played all these. That's why we know statistically that these practically either they don't work out. What could have happened here? I'll tell you one thing here, and it almost did back in. I have to cancel this thing here. Look at here. Look at the gold chart here. It was a breakdown here. People that if you buy here on those slanted planes, the more slanted, that could have just kept going down. Was below the 1 year, below the 3 year. Like this could have happened here. Like people don't think of that in hindsight. Oh, the gold price went up, and they forget that this was actually a roadmap. If you would have asked me back in 2018 to see that chart just like that without other way of evidence, I would have told you my bias is neutral bearish because what want me to tell you? There's a it's unless it's a false breakdown and a reverse through the like a reverse move upwards. Until that happens, this is what I have in front of my eye. I have to deal with this, right? So you cannot be long here unless you're a knife catcher. If you want bragging rights, but I don't care. Like nobody should be. I'm never impressed with somebody who tells me he bragged that he bought the low. It's like it's nonsense. I'd rather have the low in the rear view mirror and the market's telling me that it's already trying to create upwards momentum. So that's a great example. Same thing here. Look back in the low in the steep, even if a crazy move upwards, you're still not out of the park. And over time, it creates, oh, look at that, -8 degree instead of -6 degree. So a lot less downwards force. And eventually you get a horizontal plane above a wall. Here's a support, turn resistance. There was resistance here. Sellers got in. And that was, look how well it held on the retrace. I said, like, I think 4 times out of 5, there's a retrace to the breakout line, retrace, and bam, you buy that. That was off it went, right? So horizontal planes are any pattern that has a horizontal plane in it. And that's why people sometimes they said head and shoulders. Well, what is head and shoulders? Why are they so powerful? Because the breakout is a horizontal plane. And I don't really care about the left shoulder, but the right shoulder will be, well, let's say it's a head and shoulders bottom. The right shoulder will be a higher low, right? So and higher lows, what is that? That's the beginning of an uptrend, right? All upwards trend have higher lows. And eventually, once you're above the horizontal plane, that means it confirms that you also have a higher high. So now you have a channel, you have higher lows, and the horizontal plane confirms that you have a higher high. And that's bullish evidence. It's a bullish momentum. It's an uptrend. It's all the characteristics of a higher probability trade.
How well does this kind of thing apply to various time frames?
Well, it's like Inception, the movie. Everything I described here applies to any single time frame. So the time frame is the multiplier of the pros and cons of that. So I could have zoomed in. This pattern here, this fractal here, probably appears 100 times on the hourly chart. You could probably see these like all the time there. I even did one recently on Twitter. Let me just zoom in. I did I did silver. So here's silver to SPX. I'll just go in here on the 1 hour chart. Reset chart view. Look at that. It's like, let's say I would hide here the time frame. It's the same concept here. I have a descending 44 degree. It's that, you see that breakout here? It's not the one that brought it back to the top, right? Then after that, you had a slightly less steep. Oh, okay, cool. The market's creating a swing highs. And then after that, you have a horizontal plane. Then each time these horizontal planes are, you have to always look to the left as far as you can to see meaning. So that's the same thing. I'm on the 1 hour chart. If I go on the monthly, you saw it on the monthly, right? This thing does, it's nothing on the monthly, right? Reset chart. Look, it's these are all my lines. I could practically not see it. But so it goes with the pros and cons of that time frame, right? that, let's say you have a bullish pattern on the 1 hour chart, but if you don't zoom out to the higher time frame, that bullish pattern might get a rug pull because you might be hitting monthly defined resistance, you might be hitting a 12-month moving average going downwards. So if you want to play a shorter term time frame bullish setup, make sure the time frames below it or above it, the 4 hour, 8 hour, the 12 hour, the daily, you're not going to hit any resistance, and you're actually in an uptrend in those. Because if you're in a higher time frame defined uptrend, there's more chances that capital flows go in and saves your butt from that. Instead of me having a false breakdown on that 1 hour chart, I have more chances if there's just an influx of money coming in and, oh, I reached my target. So it's all about probabilities, right? So you can zoom on time frame, but always be aware of the entire ecosystem of timeframes that are out there.
Yeah, makes total sense. It's one of the things I look at a lot. Most of my trades are shorter duration than year plus, but I actually talk about a lot of the very same things. So again, I can't help just find it funny that different styles of trading, but very similar things that you're covering here, which is pretty interesting to me. When you look at these different ratio charts, I remember the first time I talked to you, I thought that was pretty neat that you looked at a lot of these different kind of ratio charts. We're looking at one now. What's the thought process behind those? And if somebody was new to them, how should they dip their toe into using them?
Okay. So if I would do ratio charts, like essentially people are looking at ratio charts, they don't even know it, because any instrument, it's a 1 unit. Let's say I go to Amazon before. That's a ratio chart. It's one share of Amazon divided by the numerator is Amazon, and the denominator is 1 unit of US dollar, right? Or it costs so yeah, so it's the unit. So it's here I need 250, or wherever the price is today, I need 153 units of US dollar to purchase 1 share of Amazon. That's a ratio. So by using ratios other than fiat, because fiat has been there's a destruction of purchasing power of the fiat that's been going on forever. So US purchasing purchasing. Just to preface this, this is your purchasing power, guys, since 1913. So unless we go into Great Depression.
For anybody that's just listening in, it's essentially a completely negative sloping line. The best way to describe it.
Yeah. Unless we have the destroy money, unless we have a huge deflation and the actual remaining US dollars are able to purchase more units of more shares, etc. We've been destroying purchasing power forever, right? Like it's our running gag. Everybody knows it. We have analogies. A carton of milk. Ask your grandfather. I love, like, when I was young, I didn't understand there, but when you see a chart like that, it just goes down. So yes, Amazon's going up, but the unit you're measuring it with might be Amazon shares might be going up because the units you're measuring it, comparing it to, are going down, So are you really making money, or it's just because the unit is losing value? So if you go back to SPX divided by, so if you want to do ratio charts, the easiest one to do, guys, whatever you want to buy, price it in gold. I even have here an indicator here where I have by default, whatever instrument I have, let's say, let's go pick on the Russell here. You always want to outperform. So here I have a ratio of the Russell versus gold. So that's what it looks like, the ratio chart versus gold. Here's the Russell versus SPX. So that's what the ratio chart of SPX of Russell is worth versus SPX. So you want to compare with major asset classes. You want to, if you're the Russell or any instrument, if you're not outperforming the SPX, you have to ask yourself, well, why am I long this company there, Netflix or whatever? I'm not even outperforming the index. And if you're not outperforming gold, another different asset major class, because I've shown you where there's secular bull markets in US growth stocks, there's often a bear market with gold, with commodities, etc. And when commodities are in bull eras, then there's often a stagnation period with possible rug pulls in US growth stocks. So you want to be outperforming SPX and outperforming gold to have in your head, you should always imagine what's my percentages of headwinds versus my percentages of tailwinds I have in my trade to have a successful trade. So Russell right now, while it's going up nominally, it's underperforming the SPX and it's still underperforming gold. It doesn't have all the tailwinds it needs to really be in a sustained uptrend. So that's a lower probability play. I could pop in, let's say I put in.
Quick segue. I trade a lot of IWM. So I have to grace the IWM gods with a compliment because we're talking a lot of shit about IWM right now. And I don't need them pissed off at me. So IWM, you're looking great out there. Anyways, back to you.
Well, nominally you could do great. And like you told me, like if you're on the shorter time frame, it's like that movie, The Ant. You could tell me, Patrick, I don't care about the higher time frames. Hey, I'm on the 15-second candle, Patrick. And you're right. Sometimes you're so small that it practically doesn't matter what is happening, the storm out there, right? It's like you're at the atomic level and I'm outdoors, playing. So I've had that thought, like if the guy really zooms in, like he might get in and out of this trade and he's oblivious to what's happening on the outer realms, right? So that is a distinct possibility that the gods of the Russell might still be happy with you. If you're trading on a short time frame, it could still look great.
Well, I mean, realistically, I'm going to lose money in it anyways. I just don't need more shit stacked against me. So I'm just trying to make sure I give them a goat sacrifice later today to get back into their good graces.
I do that also. I used to do that when I used to play poker. I'll always sacrifice 2 goats before I'd go on poker online. Always. It never quite worked out for me though.
I know it's not working at all, but I'm running out of goats.
Oh my goodness. Well, like Wells Fargo and their example versus gold, it's looking like it's trying to wake up. And versus PX.
What do you make of oil?
Oh goodness. Oil. Oh man, let's reset chart view. Oh man, that wick kills me. They really kill me with that negative wick there. Oil is in. It's like hanging on. It's like it went up super strong. You could still consider this a longer term back test from the peak in 2008, one touch, 2, 3, 4. Here was messy, broke out, retest. So this is a clear, valid breakout. But again, it's not a horizontal, like we just talked about there. The final breakout is probably going to be here. If ever oil is able to close above 115, then it's going to be probably bonkers. So for me right now, it's in a back test configuration, but it's mixed signals because it's below the 3-year, it's below the 1-year moving average, it's above the cloud, it's above right here. There's some, it's like a pivot line, resistance, support, resistance, support. Look, I'll zoom in here. It's in survival mode right now. It's like it's above support, but you really want you can it's hard to have a position here because you want it to at least clear this line here. And even this line, it's provisionary because it only has two bounces. For a line to morph into existence, you need 3 reactions. So we might have one small reaction here to confirm that line exists, and then we'd probably have a reverse symmetry move back to 115. That would probably be the play eventually there from 81 to 115. But it's got that line. This has to support this confluence here of support. All this has to hold here. And there's a lot of volume base, like a huge volume defined base right here, right below. But you want that 70 to hold. Ugh, goodness, man. It's like, yeah, that's how I see oil right now. But there's some good signs because some of the tankers, they're doing great. So if you look at other instruments like Frontline, look, there's the oil shippers have been doing great, like for a long time. This thing's paying 17% dividends. Like we've been in this thing for a while, and the oil tankers have been in uptrends for a while, right? So there's some bullish signs for oil that what we're living through right now is simply a more back test of that breakout line, and the markets are pricing in ahead of time a rebound in oil, because the oil plays they're not that bad. The oil plays there.
How do you view looking at subsidiaries of broader commodities like this? Because that's actually an interesting angle that you're bringing up. And I'm curious how that broadly applies. So, in this case, we're looking at an oil tanker in relation to oil. Does that apply across sectors, across commodities to you?
Always, always. And if you want people to know the next step for racial charts, it's the same thing. So let's say I would take, let's say oil was breaking out. Okay, fine, oil's breaking out. Then is oil breaking out versus XOP, let's say the sector of the ETF?
Mhm.
You would want the sector to be outperforming oil in a bull era. And look at this, man. This actually oil has broken down versus XOP, which is bullish for the sector. So even if the oil price has consolidated and retesting that 70 level, the the oil plays have actually are outperforming. I could have actually done maybe visually it's going to be easier if I do XOP divided by oil. Goodness, that HMO cloud is so messy. Probably have to zoom in. Sometimes to remove noise, I go on the quarterly for the oil chart to remove that wick. See that crazy wick, how it didn't, because the price didn't last long there. So yeah, they're above that's a 3-year moving average, and that's the 9-year because I'm on the higher time frames. So it's looking not bad here. So that looks like a pull flag, expanding wedge here. Oh goodness, so that's a good sign, yes. So you could use it like that. If the underlying leverage plays to the commodity or outperforming the commodity, that's full throttle for the bull era, because often it's the top layer commodity that has to fight versus the SPX, has to fight versus um, gold. But once the major commodity has the capital flows, then after that, the metrics look so much better for the companies, right, that are dependent on the price of that commodity either going up or, well, going up, right? They want that commodity price to go up. So this is very bullish actually there. I haven't looked at that. Thanks. I'm gonna have to deep dive that one because I haven't looked at the XOP by oil price recently. I kept looking at XOP versus SPX, which is a baseline, but this is yeah, this is a good sign there.
Interesting.
Look
I
at
think
that.
what's even more interesting is that you said you had a 9-year moving average, which I can unequivocally say I've never had one of those on my chart. Are they fun to watch? I imagine they're boring as shit.
Yeah, too long. Nine years. Look, 9 years. It's when I do the big picture, 7 years, 8 years moving average, just a really long term moving average there. But to trade, what you could do is you could have that moving average. It's fine. Understanding where it is, it's great because let's say here I'll put instead of my 12-month moving average, I'll put the 9-year, which will be or 8-year, even 7 years long. I'll put 7-year. Understanding where you are. You see here when you had the breakout in June of 2019, you were right above the 7-year, which is great. And look, see how you got stretched away from the 7-year. Here was a pullback. You don't want to be too stretched from any type of moving average because the more stretched you are, the more you're at risk of exhaustion, right? You want coiled and tight. Here it is, the 7-year and the 3-year. Coiled and tight. That's where the market is okay. I don't know where to go anymore. And once it takes a direction, then it allows for price expansion, right? Because the further you are from a moving average, the more FOMO there is, the more people are making money, the more they're talking about they're making money, the more people at the water cooler are buying. But once everybody's bought and you're super stretched from the moving average, then naturally there's only one place could go. You have to let the moving average catch up, either via a violent bear market or a sideways move where you could let those moving averages catch up and replenish, let the ones who got in low, let them exit, let them take profits, get out of the game. And then after that, let new people come in to buy. But you don't want to be too stretched from the any moving average, right? The best is when the 7-year, 3-year, 1 year, 1 month, all those moving averages are, well, here I have a setup here called the heat map. I have the 7-month all the way to the 5-day moving average. And you'll see that often the best moves, look at that. It looks like a rainbow. You've seen these rainbow type of indicators. Well, here in June of 2019, you have the shortest of time frames plus the 700-day moving average, which is not that bad, a year and a half, coiled and tight, man. You got to get, people have to focus on coiled and tight, not, let's say you tell me about, hey, Patrick, I think gold's a buy. Everybody's talking about it. It's the next thing. Peter Schiff says it's going to 5,000. Well, I would look at often if somebody tells me, or somebody from my family tells me to buy something, often I'll look at the price chart and I'll have something like this where the price is getting so stretched from the longer term moving averages where it's just asking for a pullback. Just like here, look at that. Look at the beautiful pullback, the GFC here. It was getting stretched from the moving average. Either it consolidates sideways here, but it could also come and did a severe retest of the 700 moving average. Look at here. Goodness. Look how tight and coiled that was. Goodness. So these are the setups, like the setups that don't happen often here. And here we've had it just again. This is just a coiling and tightening pattern. And if it starts moving up, the further you are away, the more the move has been engaged.
I couldn't agree with you more on the tight. I think everything's better tight. Real big fan of tight. So for anybody listening, I feel like if you needed a solid moniker to get better at understanding moving averages, that's the real, I think that really sticks through for me is the tight. Just like a nice bench press. Yes. Got a solid tight elbows for that drive. Hell yeah.
Oh man. Well, yeah. Yeah, I'm gonna get in trouble. So I'm gonna usually I get in trouble, but it's so hard not to do that joke. I've been watching The Office recently, and that's what she said. Jokes, they're just the best, man. It's like they just before the woke culture came in, you could see the woke getting in towards the end of The Office there in 2008 or whatever year. Like, oh no, maybe later there, but the beginning of the years, it was like just
hilarious.
It was bonkers, that show. I love it.
Well, and I mean, that's exactly the setup for that joke I was just doing anyways, right? Obviously, I'm talking about other stuff, but I transfer it to make everybody feel like they're fucking creeps by talking about a sick bench press, which is also great if you have some tight elbows and a good bench press, but...
Well, I'm sure we made a lot of people laugh, and good for them if they caught on there. I love it.
Yeah, good. A couple other questions I had for you is looking back at 2023, what stood out to you? So if you are a relatively new trader, you're building your technical analysis, understanding, and awareness, what are some things that you saw this past year that you think would be good for them to take a look at as a reference point, as a data piece that they can integrate into their broader technical understanding?
Oh, goodness. Well, I think it'd be ratio charts, understanding if you should trust or not is it a bear market rally or not? Because sometimes even if like we did the Russell chart, even if nominally, I'll do it again for the Russell. We're gonna anger the Russell, the Russell
I was
gods.
just gonna say, as long as we're not talking shit about the Russell, we're good. If not, I'm gonna have to start lining up more goats, man.
So look here's the Russell. I'm sorry. I like picking on the Russell because it's the weakest of the Russell actually is it looks exactly like the inflation adjusted version of the Dow Jones or the SPX. The Russell is like a play on the capacity of the major indices to outperform inflation. But in any case, here's the Russell. So 2023, we're right here. So while we know the Russell is driving upwards or trying to, it still hasn't broken out versus gold. So it doesn't have the headwinds, the tailwinds that it needs to be successful. So I would always look at ratio charts. If you're outperforming a competitive asset class, so let's say NASDAQ is probably outperforming gold in 2023, hasn't broken out yet, but it had tailwinds had more tailwinds than headwinds going into 2023. Oh my goodness. No, in 2023, it hadn't broken. It broke down in 2022. Yeah, 2023 was starting to, let me just put my black line here. Yeah, so that was a positive here. So somebody would have looked at the ratio chart of NASDAQ versus gold as it was bouncing above the cloud here. But goodness, it's not the best of scenarios here. It's like, it's still, goodness, the way you'd still want, you remember, like I said, those steep lines, sometimes you have a rally, you have to wait until the dust settles. I'm really curious to see how that's going to end the month, because what I'm expecting, I want to see if we're going to get some type of a more coiling tightness, and that's probably
Tightness.
a play I'd be more interested in playing here. Something really, I can't even say the word anymore, but it is what it is. It's tight and coiled above the moving averages. So I don't want the Nasdaq to break out here and go bonkers, because it's not creating the optimal entry port for me. I would rather it have
Base more.
something like this here, where it's really creating a strong base where I could have a crazy move up here with less chances of rug pulls. But yeah, look, early in we're gonna know soon there, because here it did it pretty violently there.
Yeah, that was going to be my next question is when there's so many, I don't want to call them artificial factors because they're all market factors, but I look at Big Daddy J Powell interest rate scenario and how much that affected markets. How does having, again, I don't know what to frame them. I've always used them as artificial inputs because the market might want to do whatever it wants to do, but it has this constraint. Does that factor into these kinds of setups for you? Like, does it have to be quite as coiled and tight for you to respect it as much? Or if that broader macroeconomic picture is changing, which would ultimately impact stuff like this, does that give you a little bit more leeway with the setups that you would accept?
The macro, as a pure chart trader, the answer is the macro. All macro known elements are in the chart right there. So
Mm-hmm.
if some crazy macro thing happens, the market's going to price it appropriately. If I don't get the pattern, the tight coil pattern that I want to
Yes.
play, then I might not play it. So whatever the reasons are, so let's say, because it's hard to tell, like, can
Let me
somebody
give you
like
an example because, yeah, there's a specific scenario I'm thinking about. So right now we have
March,
it's
March?
not like what we see right now isn't quite as consolidated as you would like it to
Yeah.
see. Let's say in the next week, Powell came out for whatever reason and he says, I'm going to cut rates. And then all of a sudden that starts to fly off the handle. Does that lack of basing still impact your decision cycle against that, to your point, new macroeconomic injection of information that then might change the landscape? I'm curious how you view the basing patterns, just so you understand the meta portion of the question.
Well, my assumption is that all the aggregate of market participants are going to price in the probabilities of Powell doing whatever he's going to do. And a lot of people managing way more money than me are going to place their bets, right? According to, well, even the Fed fund futures, right? People know actually like when he's going to cut, or there's odds of, having cuts, all that stuff, all the mechanics. It's like, I clear my mind of that. And I just say the aggregate of market participants will be the price chart. So
Mm-hmm. Yeah, that's
that
my
macro
question.
element, I kind of dismiss it. I'll say, look, I'll let the market participants figure it out. If I don't get the setup that I would relish, like something like this, and I'll just move on to another instrument where I can. And that's
Okay.
another thing. Sometimes on Twitter, I get people, well, Patrick, you're not playing Bitcoin, whatever. Well, I tell, look, I don't have the setup where I know I have higher probabilities of getting my target. If I don't have the setup I'm looking for, even if the price goes up tenfold, if it just rocketed tenfold and I couldn't get in because I couldn't anchor sell stop appropriately, I couldn't get my risk to reward, the 3, 4 to 1, whatever I'm seeking, I'm just not going to play. There's so many instruments. Like, I'm not attached to Bitcoin. I'm not attached to NASDAQ. I'm not attached to any single instrument. If there's a chart with enough liquidity in a sector that's breaking out versus the other asset classes, has that pattern, that coiled, like I'll put PBR here. Here's another one. Maybe look at that. That's an oil play. That thing gives you 18% dividends. We've been eyeing this thing for a while now, because look, it's doing the coil. Look at that thing. Like, that's ready to, it hasn't broken out yet, but that thing is a candidate, like a 10-year, 13, what is that, 10-year base, man, I rather play that than play NASDAQ going bonkers off a pattern where I can't anchor my stops, or like, it doesn't matter. Like, I'm happy for you, NASDAQ, people, whoever played it. I probably have to go on the shorter time frames to play NASDAQ. I'd probably get my coiled and tight on the weekly, or maybe on the daily. I could probably play it, but on the monthly, on that chart, it's going to be difficult. But this is what I'm seeking there. These crazy patterns, and they're all over the place. You just have to do the work, and look for them.
Yeah, that answers the question perfectly. It makes a ton of sense. So you definitely have a clear preference for your setup. And if there's a specific catalyst that causes a movement, but your setup still isn't fully formed, you seem to prefer looking for an alternative that has the setup that you're looking for.
Yes.
I dig it. Yeah. And it's funny you say that about the federal funds rate probabilities and whatnot, because I typically agree with you. I think the markets are much smarter than I am, but obviously the injection of new information drastically changes probabilities of things. That's why I'm always curious how that fits into your bigger probabilistic outcome. Because like if you look at the probability of a cut a month ago, it was like 29%. Whereas if you look at it now, it's like 82% for the March meeting, which is insane,
that much.
right?
Wow.
Yeah.
I didn't even, it's great. Well, that's the beauty of charts, because I don't have to look at everything. I have there's 10,000 analysts on the planet that are reporting to their Jamie Dimons of these worlds. They're doing the work for me. They're spending hours and hours crunching all that data for me and doing recommendations, and they're buying, and they're doing the work for me. I used to go look at the Fed funds rate. I used to actually do TA on the chart of the Fed fund rates changing. And if I would see a breakout in the probabilities, I would apply that same logic. Oh, I have a breakout. So I would go for it before there was actually the cut. Let's say it was at 20%, and then it goes to 40, but I had a clear breakdown line or breakout line. I say, oh man, it's going to happen. There's a higher probability chance that we will cut, and I get ahead of the curve and play that. But I haven't done that in a while. Right now, like, I'm focusing all that stuff there, the probabilities of everything. It's like, sometimes it's like, I feel like I've done the down too much. It's like, can it be that simple? Like, I'm letting everybody else do the hard work. I'm just focusing on finding the end setup. They're focusing on getting the higher probability plays, pure, like, just on the charts there.
Yeah, I think it's a bit of a balance. I think we all go through that phase. I was actually checking out your website just to get reacquainted with you guys a little bit more. And I saw you essentially started trading right when I did in 2007. So looking over that time frame, I have done a very similar process where things got very busy, a lot of noise, a lot of stuff. And then I look at what I do now, and a lot of it is very basic in its structure. So I really believe a lot in Leonardo da Vinci's concept of, like, simplicity is the ultimate form of sophistication.
Wow,
and I think
he said that?
He did.
Wow,
and it's one of the best things that we talk about in the Marine Corps as well, which is brilliance at the basics. If we have dudes that can do all sorts of really cool maneuvers, but they can't fucking reload their rifle, that's useless to me. So we need to be really good at the basic things. And it's really impressive, actually, like the outcomes you can produce if you're really, really, really structurally sound at the basic stuff. So
yes,
Patrick, it's a blast chatting with you, man. Like I really have an opportunity to learn a lot. That's one of my favorite things about doing the podcast is I get a chance to really peer into other perspectives. And one of the goals is to just promulgate these different approaches to markets. So thanks for hopping on and spending some time chatting with us. Quick question for you. I will throw links to your Twitter and your website in the notes below, but is there anywhere else that people can get a hold of you that you want to direct them to?
No, that's great. We have a YouTube channel also. People could go check out there, North Star Bad Charts. And yeah, no, it was fun, Erik, there. Maybe we could host you there on our show there whenever you're available there. That could be fun also there.
Yeah, it would be an absolute blast. And I can bring the goats so that we can get the IWM gods on our favor. And I will be ready to talk about coiled and tight as much as you are. So whenever you're ready to rock and roll, I am.
Let's do it, man. All right, Erik.
All right, brother.
Thanks, guys.
Thanks for hanging out.